Just an update on recent markets. As you may have seen, February was a difficult month for emerging markets. We gave back quite a bit of the gains that we saw earlier in the year in January. We had a very strong January. That came, basically we had that correction in February, which was around China geopolitical risk, the potential for further rate hikes in the Fed, with strong data coming out from the US on employment, on inflation. But into March, we saw the market stabilize and actually have recovered somewhat significantly. We still are constructive on emerging markets. Everything that we had thought coming into the year, still basically that backdrop exists today. China is recovering. China is opening up from a very harsh lockdown last year in COVID. We actually had a presentation on the China property market yesterday from one of our analysts, one long. And we are constructive on China property. We think that that's key to a Chinese recovery. We also are constructive on the Chinese consumer coming back. As many of you know, there's pent-up savings of trillions of dollars, literally, to be spent in terms of Chinese consumption. And we think that that's going to be a big driver of growth, not only in China, but also in related markets. We had one of our analysts, Jamin Shah, traveling to Thailand the past week, where he came back very, very positive on the opening of Thailand, the increase in tourism. And it's not going to just increase, it's not going to impact travel companies directly, but also it will impact banks, financials, companies that sell, consumer products, just as the Thai economy recovers. So we think that that will continue to be a theme this year. In addition, the commodity complex continues to be strong. We had the BMO conference in Miami this week, where attendance was 30% higher than last year. Very importantly, you had OEMs, companies like GM. There were 20 companies there attending, focusing on commodities. One of the new changes in the commodity complex that we're seeing this year is the desire for OEMs to secure supply. And one of the ways they do that is investing in companies, long-term contracts, buying companies, equity investments. So that is very interesting. We also saw government officials attending the conference, the commodities conference. So when we look at the three drivers for markets this year, China opening, commodity complex being strong, and then finally the last one, where monetary policy in emerging markets will start to ease. As many of you know, countries like Brazil have preempted basically the Fed and the ECB in hiking rates. Real rates in many of these markets are very high. Brazil, for example, has real rates of now approaching about 8%. So very, very high real rates. And we think that with emerging markets not putting the stimulus in during COVID, they have the ability to recover without having that dramatic inflationary push that we've seen in the US, the UK, Australia. Many of these economies have unemployment rates of anywhere from 10 to 15%. Many of these economies also are very much below the potential GDP. So when we look at, again, the three drivers for growth this year in EM, China recovery, commodities doing well, and then monetary policy easing, we still are very positive on the outlook for EM. At this point, the portfolio trades at about 11 times earnings, very, very cheap or reasonable valuation. The upside, the earnings growth of the portfolio is approaching 30% over the next few years, very, very high earnings growth rate. And if we look at the upside to price target today, it's about 49%. So very good upside. We have reasonable valuations. We like what we see in the portfolio. And we think 23 should be a very strong year for emerging markets. At some point, the Fed will pause. Not exactly sure there. Chairman Felipe think it's probably around mid-year this year, at around 5.25, 5.5, maybe slightly higher. But we are seeing signs that inflation's starting to roll over and that economic growth is basically moderating. So with that, thank you very much for your support.